and I'm certified financial planner David Somerville, and I'm joined on today's show by chartered professional accountant CPA Rob Greatrix from Niagara Falls, St. Catharines. Rob, thanks for coming out on a cold wintry night and sharing some tax
exciting
planning.
Tax news.
Tis the season, right? So we finish Christmas, we
Yeah.
finish Valentine's Day, and then of course it's tax time.
Here
And
we
you know,
are.
Rob, there was an article in the National Post a few months ago by Jamie Golembeck from CIBC. He's a tax guy there.
Yep.
And he kind of put together a list of some top tax changes and the new rules that are going to affect your income and your finances in 2023. So let's just talk a little bit about some of these rules. And I'm guessing on your end right now, you're looking at all the different ways that people can, claim here, a deduction here.
Yeah, of course, sure.
It's that time of the year,
Yep.
right? Yeah.
Yeah,
So
we get a lot of questions. Yeah.
yeah, so I want to talk about the first one here in the article. And he talked about the tax brackets in 2023. So the first 6 of our tips this week are going to be 2023
Yeah.
strategies, and we've got a few strategies from 2022, the 2022 tax year. But let's talk about this whole tax bracket change in 2023, Rob.
Yeah. So that's it was interesting that CRA has, during the COVID years, not much was happening with CRA in terms of adjusting tax brackets, adjusting deductions, limits, things of that nature. Everything stayed pretty stagnant. Now that we're out of COVID, or hopefully for the most part out of COVID, they've done one fell swoop. And before, things would change by a point or two a year, a percent or two a year. Now they're doing a 6 percentage change to the tax brackets and to a lot of the credits. Like basically all the kind of standard things on a tax return are all kind of being increased by 6%. To recognize, I think, these last number of years, the inflationary increases and things of that nature. So it's, things, a bit essentially stay the same. It's just everything's just a little wider.
So let's break down a 6% change. So
Yeah.
let's look at the basic tax bracket, right?
Yeah.
So the lowest tax bracket is up to about $53,000. So, a 6% savings. So let's say it was 51,000
Yeah.
in 2022. So by going from 51,000 as the lowest tax bracket to 53,500,
Yep.
it just means that the taxpayer pays a bit less tax.
Yeah, that's right. It just makes those brackets a little wider. And there's 4 brackets in the federal side of things. And so all those brackets got a little wider. So you can earn essentially more income in those brackets before you flip into the next bracket. So, yeah.
Yeah. So you know what? One of the things is that the government typically is a taker. This is actually a good thing for, I think, most
it's good.
taxpayers.
I mean, and some of the like even things like RSP limits and TFSA limits, like a lot of things went up. A lot of the things that help taxpayers out actually have gone up and allow you a little bit more flexibility to do a little more.
Speaking of tax-free savings accounts, so right now the 2023 contribution limit has gone up, and it really is one of the best vehicles that they've given us from a for savings for retirement, saving for investment purposes.
Absolutely.
Let's talk about those TFSAs in 2023.
Yeah, so they've raised the limits in the TFSAs. I think the contribution limit now it's going to add $6,500 instead of the old $6,000. RSP again, they're giving you the limits to over $30,000 now a year that you can do into the RSPs if your income justifies it. So these are all things that I think CRA is kind of giving back to the taxpayers to help with the burden, because it's been a tough few years, that's for sure.
And the one key thing with the TFSA is that the maximum limit you can put into it is $88,000. And the one thing I want to say to those that are tuning into the show today is a lot of seniors in the past, a lot of people in the past thought that the tax-free savings account was a savings vehicle where they would go to their local bank and they would put money into an interest-bearing account. It can be used for anything. It can be used for stocks, for bonds, for mutual funds. And again, the limit now is $88,000. And again, if you haven't used up your $88,000, make sure you go up to $88,000. If you go over $88,000, Rob, then there's some penalty fees. So it's really important.
Got to keep an eye on that for sure.
Absolutely, right? And the RSPs, again, too, it's amazing, right? I think back 10, 15, 20 years ago, the only game in town was the RSP. Everybody was putting money into their RSPs. I find it's not as much of it's still there. It's still being used, obviously. But again, the limit here for those that make the biggest amount of income, 18% of your income up to about 30, close to $31,000 for 2023. So again, gives people more money to put
Yeah.
away and defer some
And I
tax.
think I think your comment on the RSPs and the maybe people, because there's more to do now, right? People are saving for education, so RESPs, they have the TFSA, so it's hard to to get to fully capitalize on every one of those opportunities. So people are picking and choosing depending on where they are in their life, right? So just
Exactly.
spreading it out a little bit, I
Yep.
guess.
Yeah,
Yeah.
makes total sense. The fourth strategy here for the new tax rules for 2023 is going to be the old age security clawback. So this is a really big one
Yeah.
for those that are over 65 collecting their old age pension.
Yeah.
Rob, just talk a little bit about the clawback and how it works
Yeah,
for
so
our
old age
listener.
security is the government funded pension. It's CRA does start clawing back that pension if people over the age of 65 start earning in excess of certain amounts of dollars. So that limit used to be, we used to always use 80 as kind of the number. It was, I think, 81 and change. But that number is now going up to over $86,000 in 2023. So that's, it's pretty significant that you can, bump
Yeah.
your income with RIFs or, other, sources that you might have that are taxable. It gives you $5,000 more for that cushion, I guess. So
Absolutely.
that's good news.
And what it does mean too is that if you go over the $87,000 limit, for every $5 you go over in income, there's a dollar taken away from your old age pension.
Yeah, that's
So
right.
the way it stands right now is 86,912 is the base level. So if
Yeah.
your income goes more than basically $87,000, there's a clawback. At about 140,000 of income, your whole old age pension is
It's
clawed
gone.
back.
Yeah.
So it's really important that if you're earning income in retirement, if you're working, you've got rental income, you've got investment
Yeah.
income, things like that, earned income, you got
Yeah.
to be careful. You don't want to make more than 140,000. You can, but if you do, you're going to basically forego your old age pension. And then what we would suggest to people that are earning big incomes in retirement is just defer that old age pension for a couple more years, and you can defer it
Yeah,
till
you can
you're
defer it.
70.
There's pension splitting opportunities out there for people as well, so that we do a lot of work in that area, trying to smooth things out, to make sure that we're not infringing on those limits. And I do find that people in that age group really value the old age security, so it's something that a lot of seniors don't like
Well,
to
I always say, the Canada pension, we all pay into it. It's a
yeah.
it's a contributory pension. Old age pension is the freebie, right?
Yeah,
So
that's the one that yeah,
who
yeah,
wants to give it up?
yeah.
Number 5 here on some of the new tax changes for 2023. It's that first home savings account. So maybe Rob, get into a bit about that new benefit for those that are going to put money away for their first
Yeah,
home.
this is brand new. It's something I think's been overdue for a while in Canada with the values of homes going the way they're going. It's the younger kids coming up. It's very difficult for them to get into the housing market. So this is a program that they've started that basically you can take $40,000 of your RSPs. $8,000 a year for 5 years, $40,000. Basically, you're allowed the tax deduction, so that should generate in a lot of instances a refund. That goes into the RSP. Now, normally with RSPs, when you withdraw money from your RSP, you get the refund when you put it in. You pay tax on it when it comes out. Well, the interesting thing about this program is for that $40,000 designated for what they call the FHSA, that money is not taxable income when you take it out. So the 40,000 goes in. Hopefully that generates some refunds for you. The growth is also not taxable when it comes out. So whatever that 40,000 equates to in terms of growth, then maybe 40,000 the other day ends up being 55 or $1,000 with your refunds and the growth. And so it's a little bit of a to help younger people. It's for first time home buyers, so it's certainly aimed at probably the younger population to help them out. So it's a step in the right direction. Is it a be all and end all for getting into the housing market? No, I don't think it goes quite that far. I think at some point, I think CRA and the government has to, maybe increase these initiatives to allow parents maybe, to start the program maybe, when the kids are, when our children are born, we save for their educations. Right. We have RESPs, we do things like that for their education. Perhaps there should be a product, at that level, and then that could be transferred to kids at 18 to help them and maybe gives them a little bit of step, into the right direction when they're getting into the housing market. It's something already established for them. But for now, this is what's out there. something's better than nothing.
Well,
So
it's great, right? I mean, at the end of the day, it starts in April of this year. We haven't seen anything on our end
no,
to show direction as to the accounts being set up, but we know it's going to be in place as of April of 2023. But yeah, it really is a great deal. I mean, $8,000 per year. If your child's 18 years old
yeah.
or 18 or older, you put 8,000 in. Again, tax deduction is fantastic. Grow it for 5, 10, 15 years, hopefully, and it's non-taxable.
Yeah.
So it's
I mean, the
great,
biggest thing with young people, I mean, obviously the biggest is that what's the value of the deduction? Because normally kids that age don't have a great income to use the deduction against, right? So you can save the deduction. You don't have to do it in the year you do the $8,000. You can save it. It's an elective deduction. You can wait till your income, till your income gets there. So those are all things you want to talk to your, your advisors about. Yeah.
And speaking of homes, let's talk about the last point here on the rules for 2023. It's the anti-flipping rule. So maybe just explain to our listeners about that.
Yeah, this is something, I mean, we've been hearing about this for a number of years. I mean, obviously with home prices and the way they're going, CRA is really putting a focus on some of these transactions. I mean, essentially, if you think about home, when you sell a home, it's going to fall into one of three areas. It's either going to be tax-free because it's your principal residence and it's the only property you have. It's going to be a capital gain if it's an investment property, in which case only 50% of what you make on that property is taxable, which is obviously that's something that people like. Only 50% of the profit you make on a sale would be taxable. And the third thing is it's considered business income, which means 100% of what you make on the property is taxable. And that's basically CRA saying you're selling these homes. There's been a number of them over a number of years. We're contending that you actually operate a business. So It's just regular business income. So you're going to fall into one of those three pods. These flipping rules have really been, CRA has really been trying to get their heads wrapped around the flipping of homes. What was it really? Was it a home that you purchased intentionally to turn around and resell immediately? Or was it a home that perhaps you were going to think, well, this is an investment property for me, but maybe you just got a deal you couldn't turn down. So now all of a sudden you sold it. So it's a lot of it goes to like kind of what was your intention when you bought the house? What was your intention when you built the house? Very subjective, obviously, if that's the case. So they're trying to just set some ground rules around it. So they're basically saying if you have a home and you own it for under a year, then you cannot get the capital gains. You cannot get the principal residence deduction for that, and it's going to be
so you've got to hold it for a year.
It's a business income item. Yeah, there's some exceptions. Obviously, there's always exceptions. There's a list of them that you go through.
That's a big deal, right? So a lot of people buy these things. They buy a home.
Yeah.
They call it their primary residence. They renovate it. They gut it. They rebuild it. They flip it. They make $100,000 and they pay no tax.
Yeah.
Within that period. Now at least they have to hold it for at least a year.
Yeah, and CRA, don't be surprised if you get some questions from CRA. What was your intention on the property? Like they're trying to really figure out what you're trying to do with the property because, of course, in CRA's interests, they're trying to business income is where they want to be with it. So you're going to have to kind of defend your way out of it.
Well, here's the thing too, right? So with computers, I mean, obviously they know the history. So all of a sudden, if you have a guy, he flipped a house in 2018, flipped a house in 2019. Flipped a house in 2020.
Yes.
Had another job or potentially had, obviously there's a pattern here that this guy looks like a flipper.
Yeah.
The computer, can pick up that sale.
Yeah, they can see that now.
Come back and start looking at looking a bit more deeper into it, right?
Because there are, we do have to indicate on tax returns when you're selling a principal residence. And if you're taking the principal residence deduction, we have to also indicate that. So they have that history CRA now, and that's things that they're looking at. They're looking for a pattern. Right. And if the pattern shows that you're doing this, they're going to contend you're running a business, basically.
Perfect. Right. So some of the last quick points here for 2022. So for this year's tax return, Rob, you made a note here, the vacation stay credit. What's that all about?
Yeah. So there was just a couple small changes. The changes we just spoke about were implemented for 2023, which really doesn't affect your return until you file in the spring of 2024. These changes are for 2022, which are going to affect these returns we're doing now. There wasn't a lot during COVID. There wasn't a lot of activity with CRA. One of the things they did do an initiative was called the vacation stay credit, where if you stayed in Ontario, if you keep your receipts and, there's various things that, it's essentially is really around hotel stays, travel. Right. If you spend $1,000 as an individual, it's a tax credit, and $2,000 for a family is a tax credit. So it's actually going to realize a bit of a tax reduction or a refund on your personal tax return if you've been traveling around in Ontario. So it's something you definitely want to tell your advisors about if you were
So
staying
think back in 2022 if you stayed somewhere up north or
yeah,
at a
north,
cottage or
cottages, things of that nature, right?
It may be.
Yep.
And the last thing here is the home buyers tax credits for 2022.
Yeah, so there's various things for home buyer, and unfortunately, CRA tends to use a lot of the same words in their. What we talked about for 2023 was a first time savings plan. There's also the home buyers RSP, but this is called the home buyers tax credit, which is really actually another tax credit that's on your tax return for first time home buyers. It used to be it's almost like a tax deduction tax credit. It was $5,000 in the past, which really realized a $750 savings on your tax return. That's been doubled. Okay. So it's going to $10,000. So
that's for somebody who
yep.
bought a house in 2022.
Yeah, first-time home buyer.
First-time home buyer 2022. Make sure you use the home buyer tax credit. So, again, it's complicated. It's confusing at times. My advice has always been, spend the money, hire a professional person to run your taxes. And as I always say, that it's not a cost, it's an investment, because what'll typically happen is that accountant or that tax person will find 2 or 3, 4 things that you're not taking advantage
well,
of.
it's, it's complex. There's a lot of things and it's ever changing. There's always rule changes and things that are changing. So yeah, I appreciate that. I mean, I think we do, help with some of this stuff. So
no, absolutely.
Yeah.
Rob Greatrix, thanks again for coming in on a cold wintry
night.
Yeah,
that was
here.
Great. Thanks a lot, Dave.
It is tax season. So for those out there, make sure you get your taxes in line.